Most retail day traders approach dynamic market risk by relying on a completely static personal metric. They place a fixed arbitrary dollar amount, say $200, on a trade and assume they are actively managing their exposure. The core flaw in this approach is that the electronic limit order book operates completely independent of any individual trader's bank account. The matching engine does not know your personal comfort level, and it does not adjust institutional execution logic to accommodate your financial limits. When you calculate a stop loss based purely on textbook account percentages or emotional tolerance, you are dropping your capital protection into completely random, arbitrary space on the price chart. Mechanically, price action naturally oscillates through these empty, structureless voids. Your protective order is sitting in a vacuum, entirely exposed to standard market fluctuations. Because these arbitrary zones lack significant resting liquidity, price action often accelerates through them until it finds a substantial cluster of orders, which is exactly where retail stops are typically concentrated. Operating from a place of emotional comfort treats trading like a variable guesswork game, leaving the trader as a constant victim. These market sweeps demand a professional operator, requires an entirely different baseline. True risk management operates exclusively on physical order book logic. It requires stripping away personal calculations. Risk is a fixed geometric limit. It is defined exclusively by the physical walls of institutional inventory sitting directly on the electronic order book. To survive the market, you must abandon the illusion that you can control risk by managing your feelings. You must adopt the uncompromising physics of the order book. The raw, unedited data of the limit order book serves as the foundational layer of market reality, preceding any visual pattern on a candlestick chart. This chart shows a 5-minute candlestick structure overlaid with an order book depth heat map. Notice this massive concentration of passive, resting limit bids below the current price. These stationary orders create a tangible physical floor. In structural terms, this dense institutional inventory is known as a true C fading zone. It functions as a heavy macro liquidity sponge. When a downward price wave enters this specific pocket, its momentum comes to a complete halt upon impact with the resting inventory block. This is a dense, volume-backed structural vault. It operates entirely differently from an invisible, arbitrary support line drawn by a retail trader connecting two random wicks on a screen. Identifying and mathematically mapping this precise geometric boundary is the absolute prerequisite for building an institutional-grade risk perimeter. When price executes a corrective rotation and descends into the boundaries of a true C fading zone, a structural operator switches immediately from observation to execution. This data table illustrates the true C matrix. The internal value provides a premium wholesale entry gate. Inside, incoming red market sell orders from retail sellers are instantly absorbed by a thick green layer of institutional limit bids, neutralizing the sellers and trapping them. A structural operator treats this entire absorbing block as a deliberate risk deployment sandbox, a defined coordinate range for building a position. Attempting to pick the absolute bottom tick is a mathematically flawed endeavor. It focuses on localized volatility instead of structural value, which often leads to missed executions. The correct tactical operational law inside this deployment sandbox is to scale your posture smoothly. You layer multiple, smaller contract lots evenly throughout the internal coordinates of the fading zone. You are systematically building your position size entirely inside the value node. You can scale with complete clarity because of the next variable in the matrix, the outer fading zone edge, which serves as your ultimate structural guardrail. This specific lower edge coordinate represents the final absolute price tick that contains resting institutional inventory support. It defines the rigid, hard-coded floor of the entire block. By utilizing the internal area as a scaling container and the absolute outer edge as a rigid guardrail, you eliminate execution anxiety entirely. You rely purely on physical order book limits to dictate your entry mechanics. This structural layout solves the constant retail debate over how wide a stop loss should be. Traders waste hours agonizing over whether to risk 40, 50, or 60 points of exposure just to survive normal market volatility. The True C system replaces that guesswork with a strict mathematical formula known as the tick-perfect invalidation protocol. Your hard stop loss is placed precisely one tick below the final row of bids. If a 5-minute candlestick closes below this razor-thin line, the trigger is absolute. It confirms the limit inventory has failed, and institutional custody of the order book is entirely lost. For your original trade thesis, this means the underlying structural trap you relied on is broken. The resting inventory has cleared out entirely, and the support shelf is shattered. A professional never views a confirmed structural breach as a temporary anomaly or a fake-out. You absolutely do not argue with the execution engine. The moment of breach requires total psychological discipline. There is zero human hesitation. You accept the data, trigger an immediate order exit, and clear the runway. Because the stop was placed with precise geometric mapping just one tick past the boundary, the financial result is a tiny, negligible scratch on your account. Accepting a micro-scratch precisely at the point of structural fracture, rather than holding the position and hoping for a miraculous bounce, is the defining operational characteristic of an elite risk engine. Up to this point, we have treated the true C fading zone as physical armor to contain exposure, but the real value of strict geometric risk containment lies in the offensive mathematical advantage it generates. This chart illustrates the final phase of the true C matrix, the primary C wave continuation. Notice the tiny red box representing 10 to 12 ticks of structural risk at the bottom, sitting opposite a massive, uninterrupted upward trajectory, stretching toward off the fade zone floor. The aggressive short sellers who were trapped in the internal value node are forced to rapidly buy back their positions to cover their books. This sudden wave of short covering creates a friction-free liquidity vacuum. Price accelerates vertically through a wide open runway with minimal overhead resistance. Combining these two structural realities yields an extreme reward to risk ratio. You are risking a highly compressed 10-tick pocket of exposure to extract a 150-point macro rotation down the field. This visual equation outlines the resulting positive mathematical expectancy. A single clean 150-point structural capture completely eclipses and neutralizes 4 consecutive 10-point scratches, producing a deeply positive net outcome. This mathematical framework provides the objective data needed to process minor consecutive losses as a standard operating cost rather than an emotional threat. This mathematically assured operational state is the exact opposite of the constant anxiety and variable guesswork built into standard retail trading models. By anchoring your stop losses to exact structural limits rather than arbitrary dollar adults, you physically hard-code extreme geometric asymmetry into your execution logic. You transform risk containment from a defensive liability into your greatest offensive weapon.